Good morning, good afternoon, good evening, friends. Today we are going to discuss regarding the consignment concept that's used to come usually in bcom, second PUC, and even in CA Foundation and CMA Foundation. This consignment accounting is very easy topic as we already discussed in second PUC and all. This consignment accounting is an extension how a business organization can be, means in case of business entity it can even extend its business operations by opening a new branch and even new department kind of way. In the same way, the consignment is also a way to extend its business operation by way of agency. So let's discuss its meaning, what actually the consignment means. The consignment means it is an agreement between the consigner and the consignee in which consigner sends goods to the consignee and the consignee sells those goods on behalf of the consigner, which means consignment means actually in which there are two parties are involved. One is consigner, other one is consignee. Consigner means such person who is a owner of such business entity. Now he wants to extend its business operations through the agency business kind of. So he is hiring one person who is known as consignee, and now he need to sell such goods which are sent by the consigner to consignee, and he need to sell those goods on behalf of the consigner who sent those goods to him. And even though he is selling such goods, his ownership is lies with consigner only. Consignee is only having the possession of that, and the parties involved in that we already discussed. One is consigner, another one is consignee. Consigner means the person who sends goods, and the consignee means the person to whom such goods are sent for sale. And there is a procedure in order to start a consignment business. By way of extending the business organization, we can choose this procedure in which firstly consigner used to receive some kind of money as an advance as a security deposit from consignee and send such goods to the consignee after receiving the amount from the consignee. Now, once the goods has been received by the consignee, he used to sell such goods. We already discussed that is not the ownership, is only having the possession of such goods, and once he sold such goods, he used to get some amount from what he sold, and he need to refund that back, means he need to pay back that amount to the consigner. He used to usually pay that one after deducting the expenses that he incurred. Commission is eligible to receive. So next is consigner expenses. Usually the consigner expenses will be the loading charges, insurance charges, freight and carriage charges. Loading charges means while goods is transferring to consignee's location, you used to incur some loading charges in order to make insurance to the goods which are in transit, so they can claim if any kind of destroy something happens. Then freight and carriage is the normal usage kind of it, and the consignee is also even used to incur the expenses. Like once like consignor incurred expenses in order to send goods, and consignee need to like take those goods now for unloading. He used to incur such unloading charges, and the godown rent for keeping them in the safety till its point to sale, and selling expenses. In order to sell, he used to incur some kind of sale expenses. And once the consignor is selling the goods and all, he used to get commission. There are three types of commissions that consignee is eligible to receive from consignor. One is ordinary commission, another one is declaratory commission, and the one is overriding commission. Ordinary commission means is simple commission, means it's a normal commission. He used to get that one in order to acting as a normal agent in the day-to-day business activity. There is no need of acting or doing some extra. Is simply acting as a normal day-to-day business activity. For that, a percentage of amount is getting as a commission. Declaratory commission means it is an additional commission which is receiving over and above the ordinary commission for the purpose of taking the responsibility of bad debts. That in case of is sold the goods on credit sale, means usually the in order to sell the goods there will be two options. One is cash sale, another one is credit sale. If consignee choose to sell the goods on credit in order to attract more customers, he used to sell those goods on credit, and when he sold the goods on credit, If some of the customers are not ready to pay the amount, then such amount he only need to bear for such expenses what he incur for selling the goods on credit sales. For that he is getting an extra commission that is known as delta commission. Next one is overriding commission. Overriding commission is also a commission which he is receiving over and above the ordinary commission. He used to get this commission only when consignee sold the goods to the customers for the price which the consignor is stipulated na, more than that price if is sold, and for extra price what is sold, for that he used to get the commission, that only known as an overriding commission. This was the consignee's commission. There are three types: overriding, declaratory and ordinary commission. And next we come to know that regarding consignment format. Consignment format usually consists of these items. One is consignment account, another one is consignee account. In today's video, we are going to discuss only regarding the format of consignment account. Once the consignor is sending the goods, used to record that thing in consignment account. Consignment account, here goods is sending by the consignor to the consignee, hence goods are going out of the consignment, hence we need to debit. And this bank account is representing the consignor expenses. We already saw in previous page that consignor expenses including loading charges, insurance, freight and carriage. In those expenses whatever he incurred in order to transport the goods, that and all we used to record here in bank account by representing, by totaling all the expenses that have been incurred by the consignor, that is consignor expenses. Then consignee account, consignment account data to consignee account. Consignee account means the consignee's in expenses, what those unloading charges, go down rent, selling expenses kind of it, we need to record here. And consignee's commission, so consignment account data to consignee account, which representing the consignee's commission. In credit side, we when consignee is selling the goods, so we need to represent that one also by consignee account. Consignee account data to consignment account is selling the goods. And in case of transportation, any kind of loss happens by way of goods lost in transit, or any kind of due to the negligency, that is abnormal. Normal loss means that is it is an inherent characteristics of such a product. Abnormal loss only we need to do value adjustment. Normal loss is only subject to items or quantity adjustment. There is no value adjustment, hence only abnormal loss we used to consider in consignment account. And if any goods left in the consignment at the end of the year, which means the consignee is not able to sell those goods, that will leads to the consignment closing stock, that will come on the credit side of consignment account. By adding in all these things, in whichever the side is higher amount, by comparing that thing, if credit side is more than debit, it will becomes debit balance. Debit balance shows there is a profit on consignment business. In case of the credit side, the higher, debit side is more, it will leads to credit balance. If it is credit balance, it shows loss on consignment. This is the format of consignment account. Thank you for watching. Please stay, I will post next video. Please support me and even give advice in case of corrections I know. Thank you.